Gonna wrap up these earnings videos today with a little bit of alphabet stock. It's right, it's Google reporting these earnings. The stock, as you see, is up handily after hours, up nearly 8% at this point, pretty well 8%. Crazy stuff. We'll dive into this earnings report. Again, I based this somewhat off of what you saw with Facebook earnings of last week, where you expected some pretty good ad rates, where the company makes a lot of its money. Let's take a look at this. Let's take a look just a little bit. So the company's posting a EPS line of $22.30, which is a beat by $6.58. Now, that's a massive beat in terms of the profitability on this company. Massive beat, and it's really exciting to see what those numbers are. We'll see what the net income line actually looks like for them, but really good profitability line. That's a really good EPS line. And from a revenue perspective, $56.89 billion is up 23% year over year. Big increase. Beats by $4 billion. That's a freaking big beat. $4 billion is no joke. It's no joke on this company. That's really exciting stuff. TAC here at $10.46 billion versus $9.3 to consensus, and operating margin came in at 28 versus a consensus of 23%. We'll look at the finer details here. Operating income jumped 69% year over year. It's the best thing. It's the best number. The net income line, which I was pretty adamant about looking at, jumped to $15.23 billion. That seems freaking incredible. $15 billion in net income on this company. Off $56 billion is a really good net income line. It's a really good net income line. Very proud of them for that. So, really good numbers there. Higher revenue driven by search and YouTube as consumer/business activity rebounded. Again, as I mentioned there, as far as ads are concerned. Google Cloud saw a substantial uptick in revenues. It was a drag on operating income. It lost $1.24 billion for the quarter. And lost $5.6 billion for the full year of 2020 so far. Crazy stuff there. But adds a lot to revenue, but still profitability not there yet. They were able to pick up a lot in other areas, clearly, because you see a $15 billion net income line after $1 billion is subtracted from it. Really good to see. So by segment, Google Search and others was up 17.4% year over year at $31.9 billion. YouTube ads saw a 46% uptick, $6.89 billion. Google Network members properties up 22% to 7.41. Google Other was at 6.67, up 26.8, and Google Cloud was at 3.83, up 46%, which frankly, you could find it concerning that the company only brought in $3.83 billion in Google Cloud, yet saw a $1.2 billion loss. But again, it's something that's in the works, so eventually you will see profitability in that target. I can just assure you of that. You will see it eventually. So traffic acquisition costs rose to 10.47, as we saw in that previous slide as well. We'll look real quick here at the press release, see what kind of goodies we can find out of it. So you're looking overall for the fiscal year, which are the far right columns here, the far three, you can see the growth pretty well consistent overall. To see 2020 they actually increased revenue by a good margin is pretty exciting. Google Cloud increased obviously by a big portion as well. It is quite crazy to see what they're able to do there. You see, as far as profitability, Google Cloud, big loss in terms of operating income, or really operating loss. Other bets, big thing. Corporate cost, also big. But Google Services as a whole brought in a lot in terms of profitability. So really interesting to see that breakdown and how they're able to do that. But do you think once they get those segments right, what this company will be able to do in terms of that net income would be wild. I mean, it already is pretty impressive. I can't lie. Even year over year, to increase the net income line by $5 billion, it's quite an interesting number there. Quite exciting. Overall, Google advertising, to see in a year where a lot of companies stopped advertising for a hot minute, a big increase of around $8 billion in that revenue line for advertising. Pretty impressive. It is certainly pretty impressive. So that's for the most part what they have in terms of this press release. Nothing super crazy happened with this earnings announcement, but it's just really solid numbers, and that got people pretty excited. That's why the stock's up by a good bit. You look back in terms of the history of the stock in the last year, the stock's seen some good fortune, but really only up 30% seems kind of crazy when you see other companies of the ilk up quite a bit more actually over the last year. Yes, I said of the ilk. You got a problem with me? Because I'll take you around the woodshed and I will spank you. That's right. Don't even try it. Don't try it. Total current assets on this company right now are sitting at $174 billion. That's a lot of freaking money. Versus last year where they were at 152.5. So a good increase there. Total assets in general sitting at $319.6 billion. Versus 275.9 of the year prior. Really good growth there in terms of those assets. Question is liabilities. Obviously, you don't want to see that increase by as much. Total current liabilities at 56.8 compared to 45.2. Not quite the same growth as you saw in terms of assets, which is nice. And total liabilities in general sitting at 97 billion versus 74.4. It is pretty nice to see because that does mean equity rose by quite a good margin, actually. This year sitting at $222.5 billion compared to $201.4 billion of the year prior. So a $21 billion increase in terms of that equity line on this balance sheet, and overall the balance sheet just grew. So it is really good stuff to see. Looking at the stock itself, it's trading, frankly, at a relatively cheap multiple. I'm not going to lie to you. We're talking about a company that, if you go back to these revenue lines, for the full year at $168 billion, trading in a market cap of $1.3 trillion. You look it out, you really stretch that out, it's around a 7 times multiple there. So it's not the most expensive by any means, and a PE ratio at 37 is actually pretty cheap as far as this company is concerned. So nothing crazy there. I think the stock's still in a decent shape even after... I don't think it... So, if you're asking me, I think it deserved to move more last year. I think it did. I think there should have been more movement on the stock, and the fact that their main business in terms of advertising revenue was completely just eviscerated, right? It was absolutely devastated last year, yet they continued to raise revenue. They were still growing revenue in the midst of that when their advertising rates were at the lowest. For that reason alone, I think it deserves to trade at a higher multiple because it shows you these are the best-in-class companies. They're doing really well, and they're going to continue to do really well in the future. So regardless of the pandemic or not, they're going to do really well. So that's what I got for you today. Hope you enjoy this, and you have a great day.